is caught between conflicting fundamentals. Uncertainty seems to be enhanced as on both sides, supply and demand, worries for the future path for oil prices seems to rise. In this report, we aim to shed light on the factors driving WTI's price and ass's future outlook. We make a start with the latest data concerning the US oil market. The US oil market seems to be remained tight given that the API reported another drawdown, albeit narrower the times for minus 5.5 million barrels. It should be noted that EIA is also expected to release another narrower drawdown, and if combined that would imply the US oil market remained tight in the past week as demand levels exceeded production. It should be noted that the Baker Hughes oil rig count remained unchanged at 512, implying some hesitation on behalf of oil producers to close down a number of active rigs in the US. Overall, should indication of a tight US oil market continue to emerge, we may see oil prices getting some support over the coming days. Market worries for the demand side seems to be enhanced and may currently be predominant stemming from the worries about China's economic outlook. It's characteristic that China's trade data for August indicated another contraction of both the export and import growth rates on a yearly level, and the country's trade deficit was narrowed, implying the inflow of less wealth in the economies from the country's international trading activities. Overall, given the wide consumption of oil, China's demand is considered a major factor for oil's price. Should there be further indication that the Chinese economy is slowing down, or even China's manufacturing sector is facing a shrinking economic activity, we may see the market's worries for the commodities demand outlook intensifying and thus have an adverse effect on oil prices. Furthermore, we highlight that the winter months are approaching and may have a substantial effect on oil prices. Currently, there are signs that summer's peak seasonal demand is over, and demand is easing, and such a scenario may weigh on oil prices. On the supply side of the commodities trading, we highlight that Saudi Arabia and Russia extended their voluntary production cuts until the end of the year. The announcement tended to lift oil prices to levels not seen in 10 months both for Brent as well as WTI. It's characteristic that large organizations have revised upward their expectation regarding oil's price, under the assumption that oil production levels are to remain low for the rest of the year. Characteristically, Goldman Sachs expects that the Saudi cuts are to reduce its supply by 500,000 barrels per day, and highlights the risk that the Saudi Kingdom may retain the low production levels even after the end of the year. On the other hand, should the oil prices reach triple-digit figures, which is currently at a non-distant scenario, then we also see shale oil producers being enticed to increase their production levels and thus ease the market tightens somewhat with possible adverse effects on oil prices. Until then, as long as there are signs that the supply side of the oil market remains tight, oil prices may remain supported. Another issue that we had mentioned in a past report is that Iran and Venezuela may start increasing their exports and thus provide some additional liquidity in the international oil market and ease oil booths somewhat. Thank you for watching.